Hey everyone, welcome to the first Lyra Learn. This week we're going to be going through options, starting from the basics with an introduction to what options are in the Greeks, and then building up to like some of the strategies you can use when trading options, and hopefully give you a good idea of like implied volatility, what you're really buying when you're buying options, and lots of other good stuff. So let's get straight into it. Firstly, like a question I get sometimes is why options? Like, what are they good for? Why should I use them? And there's a few really cool things I love about options. The first is, like a lot of other products, they provide really good leverage, and they allow you to sort of have limited, especially if you're a buyer, they allow you to have limited downside and unlimited upside. We'll get into that in a bit. But they also are kind of this infinite payoff sandbox. Like you can make and construct any potential bet on an asset price with options, whether it's up, down, sideways, a particular distribution, lots of other things that you can do with options. And you can construct any feasible payoff which aligns with your investment goals. They also allow you to hedge risk and potentially earn yield, depending on whether you're a buyer or a seller. And options markets in traditional finance do enormous volumes, and I've seen it myself. I've witnessed the explosion in demand firsthand as a previous TradFi options trader. And they often do drive the stock market itself. If you look at things like last year with the Nasdaq whale with SoftBank, and more recently in Robinhood, you can tell the day that options listed on Robinhood, which was the 4th of August, when the stock went up 50%, simply due to the enormous options bets that were being made. So getting into options simply, like firstly, let's look at calls, and calls allow the holder essentially to lock in a price at which to buy the asset. If you're a buyer, they give you limited downside, which again is the premium that you pay, and potentially unlimited upside, depending on whether the asset could potentially moon and go to infinity, I guess, which would lead to unlimited upside. So to take an example, the ETH 28-day 3,000 strike call gives you the right to purchase one ETH for $3,000 in 28 days time. This is for a European option, which means you can only exercise at or after the expiration, as opposed to an American option, which gives you the right to do so at any point during the option's duration. The graph on the right shows the payoff chart for this position, assuming that we buy this call for $200. So if you look at the left-hand side of the graph, when ETH is finishing at below $3,000, all we do is we lose our call, because our call is worthless. We wouldn't want to pay $3,000 for an ETH if it's trading at $2,500. Which is, the call gives us the right to pay $3,000 for one ETH. But as soon as we hit the finishing price of ETH at 3,000, if it starts to go up, the call starts to have value. And at 3,200, the value of the call is worth $200, which is what we paid for it. So our profit and loss is zero. It's 200 because we can buy it for 3,000 and then turn around and sell it for 3,200. The option gives us the right to do so. The really interesting part starts to happen when the price of ETH increases to say 4,000. The option is now worth $1,000 because we can buy ETH for 3,000 when it's trading at 4,000, which represents a 5x return on our initial investment of $200 or $800 worth of profit. And once we get to, and this just keeps going. If ETH went to 5,000, 6,000, 7,000. Our returns would continue to increase in higher and higher multiples of our initial investment. So puts allow the holder to lock in a price to sell the asset instead of buy. So again, we have this, if you're a buyer, you have this limited downside and unlimited upside, which is, this upside, which is capped at the strike price. So it's not unlimited. Imagine the ETH 28-day 3,000 strike put, which gives you the right to sell ETH for $3,000 in 28 days time. And again, assume we pay $200 for this put, and here's the payoff graph. So if ETH finishes above $3,000, on expiry, we definitely wouldn't want to sell ETH for 3,000 if it's trading up here in like the $4,000 range, because we're selling it too cheap. So the option is worthless. And then once ETH, starts trading below 3,000 on expiry, the option starts to pick up value until we hit, the $2,800, price for ETH on expiry, which would give our put the value of $200, which is how much we pay, i.e. this is our break-even point here. Again, we can sell, the put gives us the right to sell ETH at 3,000. If ETH is trading at 2,800, we can sell it for 3,000, buy it back for 2,800 and lock in $200 of profit. And this profit continues to increase until, ETH, potentially ETH trading at 0 on expiry. For some hack or some reason that knocks out Ethereum to 0, then the option will be worth $3,000 because we can sell it for 3,000 when it's worth 0, and we paid $200 for the put, so our profit is $2,800, which is a 14x return on investment. So there are a few different terms that are really good to know when discussing options, because they allow you to sort of frame the discussion around options. So in the money are options which give you the right to trade the asset at a better price than the current price. So for example, the 2,000 strike call, if ETH is trading at $3,000, it gives you the right to buy ETH for 2,000, which is better than where it's trading at 3,000. Out of the money options, or the 50,000 strike put when Bitcoin is trading at 45,000 gives us the right to sell Bitcoin at 50,000 when it's trading at 45,000. So it's in the money. Out of the money are options which currently give you the right to trade the asset at a worse price than the current price. So for example, the 3,500 strike call when ETH is trading at 3,000. At the moment, if we wouldn't want to exercise this option because it gives us the right to purchase ETH for 3,500. And that's only worth it when ETH is trading above 3,500. Similarly, the 40,000 strike put if Bitcoin's trading at 45,000, also a worse price. At the money is a term that generally refers to options with a strike price that's equal to or fairly close to the asset price. So for example, the 3,000 strike call if ETH is trading at 3,000. At the monies don't have to be exact though, there's a pretty wide range there. So the 3,000, if ETH's at 3,020, the 3,000 strike call would still be considered at the money. So where do options get their value from? And there are lots of different factors. I've listed the 3 big ones here. And there are certainly more than this, but to start off, here are the 3 most important. Firstly, it's the price of the asset relative to the strike price. And this is kind of trivially true. The more in the money the option, the higher the price of the option will be. The ETH 1,000 call is going to be worth strictly more than the ETH 2,000 strike call because you can buy it for $1,000 cheaper. So the more the option, is in the money, the higher the value goes. The second factor is the time remaining until expiry. Option price is a strictly increasing function of time. The longer the option lasts, the more you'll have to pay for the option, the more valuable the option is. The third and probably the most interesting one out of these 3 is the implied volatility, which is how much the asset is expected to move until expiry. And prices, to give you an intuitive sense, prices for options tend to be high when expected volatility is high, because you're buying, this certainty. You can lock in a price to buy or sell, when things are very uncertain. The asset price is moving around a lot. And a corollary of this is the wider the potential range of prices that an asset can take on expiry, the higher vol will be. So something like a stable coin, right, is going to have very little vol because, in theory, if it keeps its peg, it's going to be trading around $1. Whereas, something like ETH, right, could be, it's $3,000 right now. It could be $2,000 in a month's time or $6,000 in a month's time. So another sort of intuitive explanation for it there. We'll get more into implied volatility in tomorrow's session. Okay, so the next thing to understand with options is the Greeks, and the Greeks are extremely important to understand the Greeks is really important to understanding options because they allow you to calculate your risk. They allow you to think about options analytically and break it down into different components because options are multifaceted. And they also allow you to find and trade the options on the board which kind of suit your trading goals, whatever those may be. So what are they? They measure the sensitivity of an option's price or value for a given change in like the input parameters to the Black-Scholes model. And we'll get more into what Black-Scholes is tomorrow as well. But for now, we're just going to focus on the first four Greeks, which are delta, gamma, vega, and theta, and go through them one by one. So delta. Delta is the option's sensitivity to price changes in the underlying asset. So if you look at on the right-hand side here, I've taken a screen grab from the Lyra user interface. We're looking at the Ethereum August 23rd, 2,700 strike call when ETH is trading at $3,300 roughly. It's a 77 delta, 0.77. That means if the price of ETH goes up $1 from here, so that the option value will increase by 77 cents. So this option will go from $789 to almost $790. Another way to think about delta is, or vice versa. So if the price of ETH drops $1, this option will go down by 77 cents as well. Another way to think about delta, and this isn't exact, but it's kind of a rough estimate of the probability that the asset finishes in the money on expiration. So if an option is 50 delta, there's a roughly 50% chance of finishing in the money in general. So, if ETH is trading at $3,000, the ETH 3000 call is roughly going to be 50 delta on a short enough time frame. And we'll roughly have, because ETH has a roughly 50-50 chance of finishing above or below that strike on expiry. It's kind of a coin flip. This also kind of gets to some of the reasoning behind why, you hear these less than 10 delta or tail options are really risky, is because there's a 90% or greater chance of losing all your money, the amount you pay for the option, because it's very unlikely that those options will expire in the money. So here are a couple of graphs, not super, more for the interested reader, not super important if these kind of go above your head for now. I wouldn't worry about it too much, but this left-hand side assumes we fix a strike K and then vary the asset price around K and describes the delta of the call with strike K. So imagine that ETH, the asset price, this is like 3,000 strike. We'll continue that example with ETH. Imagine K is 3,000. If ETH is trading at 3,000, then the delta is roughly 50. If ETH is trading at 0, then the delta is roughly 0, right? Because the 3,000 strike call is very out of the money. And if ETH is trading at like 6,000, then that means the call is very in the money. So it's pretty close to 100 delta. Delta also changes with respect to time. So this is showing how delta varies with respect to time for calls that are in the money, at the money, or out of the money. So you can see that as the time to expiry goes to 0, so from right to left here, if you're in the money, the delta goes to 100 because there's a 100% chance when time is 0 that the option expires in the money. That's trivially true. And it increases all the way up to expiry. For at the monies, if the strike exactly equals the price, it converges to 50 delta, as time goes to 0, time to expiry goes to 0. And out of the money obviously converges to 0 as time goes to 0. Don't worry too much about these graphs. It kind of just gives you a general idea of how delta behaves over time. So yeah, options in different delta. So how do I use delta when I'm making trades? And a key sort of use of delta is to be able to hedge your risk when trading options. But in terms of identifying trades that you might want to do, generally options in different ranges have different characterizations and risk profiles. And I've kind of summarized them here according to delta ranges. And please note that these are large generalizations and the outcomes vary a lot with respect to time, the hedging strategy you're employing, and the asset you're trading. So don't take read into this too much and don't take this as gospel, but like it's just a general idea, a general summary of option behavior by delta range. So in the top row here, we have the different delta ranges, 0 to 10 through to 90 to 100. And in the first column, we have different characteristics of those ranges. So for example, the 0 to 10 delta range has a very low implied volatility exposure. Implied volatility tends to be at the highest for the at-the-money options, and we'll get into that in a few slides. But changes in implied volatility don't really affect the 0 to 10 delta options much. Oops. Same with the asset price exposure, because the delta is low, right? If you have a 5 delta option, if the price of the asset goes up $1, you're only making 5 cents. So it's still low relative to the other ranges. The leverage is highest though. If you do buy like a 10 delta option, you might buy it for $1. You might buy the ETH 4,000 call for $1, and if ETH rips from 3,000 to 4,500, you could potentially 500x your investment. So you get some really big leverage with these ranges. This goes all the way up to the at the monies, for example, have the highest IV exposure. Like changes in implied volatility affect the at the monies the most. They're most exposed to vol. The asset price exposure is kind of medium, right? Because it's 50 delta. It's right in the middle. And the leverage is also medium relative to, it's more than the in the money options, but it's less than the out of the money options. You can go through, I won't go through all of these categorizations, but you can come back to this and have a look through yourself at the end. So the second Greek to look at is gamma. And gamma is a really interesting Greek. It's the rate of change of an options delta for a $1 move in the underlying asset. It's also the second derivative of the options price with respect to the underlying asset price. So delta is the first derivative and gamma is the second derivative. Gamma describes the effect that options increase in value at an increasing rate if the underlying moves in the desired direction. So if you buy a call, like let's say 30 delta, and ETH goes up and up, it means that the value of your option continues to pick up value at an increasing rate. So it's non-linear. It's not like a perpetual or a future, which is, a first order, has first order effects where like, if spot goes up, you make money. If spot goes down, you lose money. With options, if spot goes up and you're right, you make money at a faster rate as the value of your option picks up. So you can have these truly explosive second order effects in options that you just don't get for things like perpetuals and futures. And this is also kind of known as convexity. And you might hear that term bandied about with respect to options a lot. So going back to this example of the 2700 call, which is 77 delta, the gamma is 0.00026. And like this is kind of hard to interpret, but what this means is for a $1 move in ETH, this delta is going to move up by or down by 0.00026 for every $1. And because ETH is $3,300, like this number might seem small, but it can lead to huge changes in the delta. With relatively small changes in ETH. Once it moves $30 or $50, like it starts to become significant. A couple of more graphs for you here. This one's not perfectly drawn. Forgive me. I marked this up, with a couple hours to go. But essentially, this is just showing the gamma is maximized for at the money options and fades for like really in the money or out of the money options. Similarly, this shows the gamma variation with time to expiry. At the money options, and I think the main takeaway from this graph is that like, gamma decays out for out of the money and in the money options as time to expiry goes to 0. But for at the money options, the gamma explodes as time to expiry goes to 0. It can get really large. And some of the hairiest option situations happen when you have a large options position, which is expiring, in the next day or in the next few hours. Like I'm long, 1,000 ETH calls, 1,000 ETH, 3,000 calls, and ETH is trading at $3,000 and it's at the money. The gamma can just get huge and you have enormous swings in the value of your position. So how to think about gamma when you're trading. gamma is like a useful proxy for the risk of an option. If two options share the same delta, the one with the higher gamma tends to have has the higher risk. If you're long options, you're long gamma, and if you're short options, you're short gamma. Again, gamma is highest for at the money options, and as time to expiry, it can blow up. And this can, so an example here is like I'm short ETH 200 ETH 3000 calls, which expire in 5 minutes, and ETH is at 3000. If ETH jumps to $3,005, my delta is pretty close to long 200 ETH. Whereas, if ETH goes to 2,995, my delta is close to short 200 ETH. And that's a 400 ETH swing in value, in delta, which, one ETH is what, $3,000. So 100 ETH, 300K, 600, it's a $1.2 million swing in your sort of delta position. Just based on a $5 move with 5 minutes to go. Pretty enormous. And if you have this position, you would be tempted to hedge it, right? Like if ETH jumps to 3005, I'm long 200 deltas, I might sell ETH. Oh, sorry. If I'm short these calls, right? Like that means I'm short 200 ETH if ETH jumps to 3005. And so if ETH goes to 3010, then I'm losing even more money, which is this increasing losses at an increasing rate concept that we covered before. So if you're a market maker and you're short these 3000, short these calls, you might be tempted to buy ETH at 3005 to hedge your short delta. That of course means ETH goes up. And then at 3010, you're short even more deltas, and you continue to blow up, which is what this gamma squeeze term is referring to. It essentially means getting squeezed to gamma is when you're forced to continue hedging your gamma, which perpetuates losses in the underlying. It's kind of a convoluted explanation. We can get into that more at the end with questions and things like that. But it's a complex phenomenon. I wouldn't really worry about it too much, but the most important thing to remember is gamma can blow up close to when time to expiry goes to zero for at the money options. And it's one of the riskiest parts of options trading. Okay, so Vega, it's the options price sensitivity to changes in the implied volatility of the asset. So in this example here, we're looking at the same call. The implied volatility is 252%, and the Vega is $1.38. That means if IV goes to 253%, then the value of this option here is going to go up by $1.38, and vice versa if implied volatility falls by a percentage point. You can sum up your Vega across strikes and expiries, but it generally needs to be normalized with respect to time and the actual IV level itself to be a useful proxy for risk. But again, not too important to worry about just yet. We'll also be getting into more detail about Vega, IV, and the vol surface in tomorrow's session, so we'll go light on the details for it today. So the last Greek that we're going to look at today is theta. And theta measures how much value an option will lose with the passing of one day. So like effectively the time decay of an option. It's highest for at-the-money options close to expiry, and the higher the implied volatility of an option, the higher the theta. So, that makes sense, right? Like, the more implied volatility is baked into the price of an option, if it's expected to move 10% a day, it will decay more than an option on an asset that is expected to move 2% per day. For this option, right, it's $789. The theta is minus $24.92, which means that if a day passes and nothing else changes, this option is going to be worth almost $25 less than it is right now. And collecting theta is a popular strategy to generate yield. So, people, short option sellers, sell options with expiring in a week or two and try to just win to that decay. Obviously, a risky strategy, but it's one that's employed. I think Ribbon do it with their theta vaults. They just like to be short options and collect the decay as much as possible. Cool. And that's it for today. We'll get to the questions later on. Thanks everyone for joining, and we'll see you tomorrow for the next session.